Question: explain how investment strategy can amplify, rather than mitigate risk if asset-liability matching is poor. Your answer must integrate interest rate risk, inflation, and correlation effects. 8 marks. Section 1. Interpretation and key points. Quick awareness check. The hedge failure investment strategy is supposed to protect the balance sheet. If it isn't aligned with liabilities, it becomes a speculative bet. Duration mismatch. If interest rates fall, liabilities, debt grow. If assets don't grow at the same speed, the company goes bust. Inflation sensitivity. Nominal assets, like fixed bonds, are eaten by inflation, while many insurance liabilities, like medical costs, grow with it. Correlation spikes. Diversification often disappears during a crisis, meaning assets and liabilities move in the worst possible directions at once. Section 2. Logic breakdown. 1. The goal of ALM, Asset Liability Management, ALM, is about making sure the assets move in the same direction and magnitude as the liabilities. 2. Interest rate risk, the duration gap. Most insurance liabilities are long dated, paid out years from now. Their value is highly sensitive to interest rates. Down arrow rates equals up arrow liability value. If an insurer buys short-term assets to be safe, they actually create massive risk, because the assets won't grow enough when rates fall. 3. Inflation risk. Many liabilities are linked to the real world, e.g., car parts, hospital bills, or wage-linked pensions. If the investment strategy ignores inflation, the real value of the assets will shrink while the real value of the claims explodes. 4. The correlation trap. In a crisis, the safe assumptions about how assets behave often break. This is tail dependency. If an insurer assumes that equities will hedge inflation, but a stagflation event occurs, high inflation plus falling markets, the investment strategy amplifies the loss instead of mitigating it. Section 3. High distinction model answer. An investment strategy that prioritizes standalone returns over asset liability management, ALM, transforms the balance sheet from a hedged portfolio into a speculative exposure. The primary mechanism of risk amplification is interest rate risk through duration mismatching. Since insurance liabilities are typically long duration, their present value increases sharply when discount rates fall. If the investment strategy holds shorter duration assets, often perceived as low risk, it fails to provide a matching increase in asset value. This duration gap can lead to a rapid depletion of surplus capital during periods of falling yields, demonstrating that safe assets can be highly risky when mismatched. This risk is further compounded by inflation. Many insurance contracts, particularly in general insurance and defined benefit pensions, have liabilities that are sensitive to price or wage inflation. If the investment strategy relies on nominal fixed income assets, the firm is exposed to real value erosion. While management might pivot to growth assets like equities or property to hedge this, these introduce volatility risk. Under the actuarial control cycle, such a strategy must be monitored for correlation effects. In stressed markets, the historical correlation between assets and inflation often breaks down. A stagflationary shock can cause asset prices to collapse even as inflation-linked liabilities spike, leading to a dual blow to solvency. Ultimately, a poorly matched investment strategy creates model risk, as it assumes that the return will compensate for the mismatch. However, professional actuarial judgment recognizes that tail dependency, where risks converge during extreme events, means that mismatched portfolios are most likely to fail when the firm is most vulnerable. Without rigorous ALM, the investment strategy does not mitigate risk. It introduces a new, unhedged market risk that can undermine the solvency capital requirement, SCR, even if the underlying insurance business is technically sound.